The case of Sam Bankman-Fried, who was sentenced to 25 years in prison on March 28, 2024, exemplifies the fast-paced world of cryptocurrency, where large quantities of money may be made or lost in the blink of an eye. In early November 2022, the cryptocurrency exchange FTX was valued at more than $30 billion. By the middle of the month, FTX was in bankruptcy. Less than a year later, on November 3, 2023, it's found Sam Bankman-Fried was convicted of 7 charges of money laundering and fraud after a trial that lasted less than a month and included only around 4 hours of jury deliberation. What happened? In 2019, Bankman-Fried founded FTX, which operated one of the largest cryptocurrency exchanges. FTX was a cryptocurrency trading and holding platform similar to the New York Stock Exchange for stocks. Bankman-Fried also established Alameda Research, a hedge fund that invests in cryptocurrencies and crypto companies. In early November 2022, news outlets reported that a significant proportion of Alameda's assets were a type of cryptocurrency released by FTX itself. A few days later, it was revealed that FTX had allegedly provided customer assets to Alameda for risky trades without their authorization, as well as issuing its own FTX coin for Alameda to use as collateral. As a result, criminal and regulatory authorities began looking into FTX for suspected securities violations. These 2 pieces of news essentially triggered a bank run on FTX, and shortly thereafter, FTX, Alameda Research, and 130 other linked companies formed by Bankman-Fried declared bankruptcy. This left a large number of investors who purchased cryptocurrency through the exchange with no method to retrieve their money back. Within a month, the Southern District of New York arrested Bankman-Fried and charged him with wire fraud conspiracy, securities fraud conspiracy, and money laundering. Additional criminal accusations for political donations were announced in February 2023, followed by a bribery indictment in March. Bankman-Fried's first trial began on October 3, 2023, and was primarily focused on Alameda's essentially unlimited access to capital on the exchange via a hidden line of credit. Did a lack of oversight play a role? In traditional markets, firms often restrict their risk exposure through maintaining liquidity and solvency. Liquidity is a firm's ability to sell assets quickly without losing significant value. Solvency is the concept that a company's assets are worth more than it owes to debtors and customers. However, the crypto world has traditionally operated with far less caution than the traditional banking sector, and FTX is no different. About 2/3 of the money that FTX owed to the people who held cryptocurrency on its exchange, roughly $11.3 billion of $16 billion owed, was backed by illiquid coins created by FTX. FTX was collecting its clients' money, sending it to Alameda to make hazardous investments, and then producing its own currency, FTT, as a replacement cryptocurrency that it couldn't sell at a high enough price when needed. Furthermore, nearly 40% of Alameda's assets were in FTX's cryptocurrency. Keep in mind that both companies were started by the same person. This all came to a head when investors chose to sell their coins through the exchange. FTX did not have sufficient liquid assets to meet those needs. This lowered the value of FTT from more than $26 a coin at the start of November 2022 to less than $2 by November 13th. By this point, FTX owed more money to its customers than it was worth. Using customer funds to invest is forbidden on regulated exchanges. Auditors also evaluate financial statements, and businesses must disclose the amount of money they have in reserve to cover consumer withdrawals. And even if things go wrong, the Securities Investor Protection Corporation, or SIPC, protects depositors against the loss of investments from an exchange failure or financially troubled brokerage firm. However, the crypto world lacks such guardrails. Why is this a big deal in crypto? While the collapse of FTX and Alameda, valued at more than $30 billion and now essentially worth nothing, was dramatic, the bigger implication is simply the potential lost trust in crypto. Given that Bankman-Fried and FTX were once regarded as some of the most powerful and trustworthy personalities in cryptocurrency, these developments may cause additional investors to reconsider investing in the sector. What does the trial reveal about the regulatory environment for crypto? The trial of Bankman-Fried highlighted the ever-changing and complex nature of cryptocurrency laws and oversight. At the completion of the case, Damian Williams, the federal prosecutor for the United States Justice Department, emphasized the department's commitment to combating fraud, especially in the relatively new cryptocurrency field. This case demonstrates that the United States is willing to use broad jurisdiction over financial crimes against its nationals, regardless of where the perpetrator corporation is located, which in FTX's instance was the Bahamas. Despite a recent crypto crackdown by the SEC, the US continues to lag behind other nations in establishing comprehensive crypto regulations. This is clear in formal regulatory frameworks established by countries such as the United Kingdom and the European Union. The International Monetary Fund's proposal for comprehensive regulations emphasizes the need for stronger regulatory measures in the cryptocurrency industry, pointing to a growing gap between the United States and much of the rest of the globe. Finally, Sam Bankman-Fried's dramatic ascent and fall serve as a warning story for both the cryptocurrency business and the financial markets as a whole. While his story is one of deceit and hubris, it also highlights the importance of strong governance, investor attentiveness, and regulatory supervision. Also, the effects of the FTX crash will last for years, but it also provides an opportunity for the cryptocurrency sector to develop and rebuild. This story is likely to serve as a sharp reminder of the risks of unregulated ambition and a lack of responsibility.